Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So, if you played any sport at all as a kid, at some point, a grown-up told you, keep your eye on the ball. It's almost a cliche, right? But it works. I mean, kind of self-evident, right? If you can see the ball, it's going to be a lot easier to catch it or hit it or whatever you're trying to do to it. But there's actually more to the mechanics of keep your eye on the ball than that. For me, as I got older, keep your eye on the ball turned into keep your eye on the puck. And as a goalie, we learned something called head tracking. And basically the idea is you don't want to just follow the puck with your eyes. You want to follow it with your whole head. So you keep your eyes forward, and as the puck moves, you move your head so that your eyes are following the puck. So you're keeping your eye on the puck by using your head. And the reason that you do this is because physiologists have found that your body goes where your head goes. So if your head is already turning toward the puck, the rest of your body, even before you consciously realize it, is beginning to move to get in front of the puck. So head tracking is very, very important for a goalie. And, it's just imperative. You want to keep your eye on the puck or your eye on the ball. And it's not just important to keep your eye on the ball in sports. It's true in investing as well. Of course, there's not a literal ball, but you get the idea. It's really easy in the markets to get caught up in the noise, right? We get hung up on the latest post that we saw on X or, the latest thing that the talking head said. And sometimes we lose kind of that bigger picture. We take our eye off of the ball and we get caught up in our surroundings. And, we've just seen gold get pounded for the last 2 days. We're back below $4,100 an ounce. It's kind of interesting to think about because we're talking about gold getting pounded down and we're still holding 4,100. I mean, who'd have believed that a few months ago? But nevertheless, a very significant correction. And as I started doing show prep this morning, silver was barely holding above $48. So when you see that, when you see, gold losing over $100 in a single session, it's easy to panic, but you have to keep your eye on the ball. So with that in mind, I want to cover a couple of things that I don't think have gotten a lot of play in the news, but I think are very important. They're kind of balls out there that we need to be paying attention to. But first, I want to thank everybody for listening to the show. I really do appreciate it. I say it every week, but it means a lot to me that you take time out of your day to listen. And just going to ask you to do us a favor. Share the episodes. Let people know that we're out here. Give us a good review wherever you're listening to this show. Hit those like buttons. That will help grow the show, and it's a way that you can kind of help out without really costing you anything more than a few seconds of your time. So if you would do that, we would really, really appreciate it. And again, just thank you very, very much for being a regular listener. For those of you who are here every single week, it is much appreciated. So, gold and silver, both correcting right now. First, I think it's really important to remember that corrections are healthy in a bull market. Both gold and silver were definitely overbought. Now, that doesn't mean they're overowned, right? Just overbought. Overbought is actually a technical term. And an asset is overbought when the price runs up extremely fast relative to its recent trend. So we've definitely seen that in both gold and silver over the last several weeks. And there are actually metrics that technical analysts will use to determine whether an asset is overbought or not. And gold and silver both were in that category there for a while. Now, when an asset is overbought, it signals an increased risk of correction. When you have an overbought asset, there's definitely a chance that you could see it go down, but it doesn't necessarily mean that the bull market is coming near to an end. It's just signaling the possibility of a correction. Remember, markets never go up in a straight line, right? They go up and they go down. They climb a wall of worry. And so that's kind of what we're seeing in the precious metals markets. Now, just because an asset is overbought and we have a correction, it could be the end of a bull market. And that's why it's important to keep your eye on the ball. You have to look at the bigger fundamentals. You have to look at what's going on in the belly of the economy, in the guts of the financial system, to really understand kind of where we might go from here. And I think that there could be more to this than just a price correction. And there are some analysts out there that agree with this. Did you hear Jamie Dimon the other day? Now, Jamie Dimon is the CEO of JP Morgan Chase. And he was out there last week talking about cockroaches in the credit market. We saw a couple of big bankruptcies. We've seen some problems in these private credit markets. And he basically said, if you see one, there's probably more than one. That's what he meant by cockroaches. And this private credit market has grown explosively to over $1.7 trillion. And there's a woman named Daniela. I think it's Daniela. It's either Daniela or Danielle. Might be Danielle DiMartino Booth. And she's a former Fed advisor. And she was interviewed the other day. And she says that the big sell-off in precious metals may stem from stress due to high levels of bad debt in these private markets. She said she sees a significant risk and contagion stemming from lax underwriting standards that persisted during the era of near zero interest rates. Now imagine that. Incentivizing borrowing with artificially low interest rates can have some bad ramifications. Who would have guessed? I mean, it's not like we've seen this before in the subprime market of real estate back in the 2000s. You always get this. Whenever the Federal Reserve goes into these massive interventions into the market, it creates unforeseen consequences. It creates malinvestments. And that's what we're seeing. I've been saying this for months and months and months. We've never cleaned out all of the garbage that was put into the markets through the crazy quantitative easing and artificially low interest rates in the wake of the 2008 financial crisis. We never dealt with that. And then we piled on top of that with the pandemic. In fact, I would argue that the pandemic kind of saved the Fed's bacon, because if you go back to 2018, early 2019, we were seeing a lot of shakiness in the economy. We were seeing a lot of shakiness in the financial markets. The Federal Reserve had to go back to quantitative easing even before the pandemic, because there were these problems that were the result of the malinvestments that came about because we had nearly a decade of 0% interest rates. We never dealt with that. And then, of course, we still haven't dealt with the pandemic era inflation. So here we are today. So anyway, kind of looking at this private credit market situation, it's not just Danielle Booth. Bank of England Governor Andrew Bailey recently testified before Parliament over there in Great Britain, and he drew a direct parallel between recent blowups in U.S. private credit and the 2000 subprime crisis. Now, everybody's going to tell you, oh, it's contained, there's no problem, the economy's great. That's exactly what they said in 2006 and 2007. Financial stability reports from both the Federal Reserve and the International Monetary Fund have highlighted the rapid growth of this kind of opaque, less regulated market as a potential systemic risk. And of course, they're going to focus on, oh, it's not regulated. That's not really the point. The point is we have a central bank that keeps intervening in the financial markets and creating these misallocations of assets and these debt bubbles. So this is Booth in this interview. She said, if the lending standards have been laxer than they should have been, then we're going to find, as Jamie Dimon would suggest, more cockroaches. And she went on to assert that the risk across the entire consumer loan spectrum is high. And she cited the New York Fed's latest data. U.S. household debt stands at a record $18.4 trillion. Credit card and auto loan delinquencies are rising steadily above pre-pandemic levels. And it's interesting, I wrote about this last week, and I'll link to an article in the show notes page, but consumer revolving credit, which is primarily credit card debt, we're starting to see that contract a little bit, which indicates to me that American consumers are stressed. They've run the credit cards to the limit. They're trying to keep up with price inflation, and they can't do it. So we're in this situation where there's a lot of cracks and ripples, but they haven't quite become visible enough for people to really start paying attention to it. Now, Booth thinks that some investors are liquidating their positions in gold and silver, not because they want to, but because they have to, because they need liquidity. She argued we're not seeing any kind of fundamental rejection of precious metals right now. She thinks there is essentially forced selling in what she called a dash for cash. Now, we've seen this before. The last time this dynamic reared its ugly head was during the early days of the pandemic lockdowns. Remember how gold and silver both sold off before they roared higher when the Fed started going ballistic with quantitative easing and cut rates to zero? Booth said, I think that's what we're witnessing right now. I think we're witnessing a repeat of what we saw in March 2020. Investors who receive margin calls or need to raise cash quickly often are compelled to liquidate their most profitable and liquid assets. That's gold and silver. So, she makes a good case. She says people tend to, if they get margin calls, if liquidity becomes an issue, they tend to sell their winners, Booth explained. She warned that this volatility that we're seeing right now is not healthy. Quote, you never want to see gold behave like a meme stock. So her point is that, this big sell-off, this quick sell-off, is telling us something about what's going on underneath the surface of the markets. And it's just like the big run-up in silver all of a sudden was telling us something about what's going on in the silver market. Remember, we were seeing this silver squeeze. We were seeing a shortage of metal in London because of a lot of different factors. But ultimately, it goes down to a more fundamental shortage of metal, period. There's not enough silver to go around given the demand. And so we had this squeeze. Now, they can solve the squeeze temporarily by, shifting metal back to London from New York. And that's what's happening now. And I think that's why we've seen some easing in the silver market. But it doesn't solve the fundamental problem that we're not mining enough silver to meet all of the demand. Fundamentals. Keep your eye on the ball. Okay. So, these high levels of volatility, if they make you feel a bit cautious, they should. Natural. But if you're keeping an eye on the ball and focusing on the underlying dynamics, big dips like this could present a buying opportunity. If you're looking at the bigger picture and you're thinking, I'm going to want to hold gold and silver, I think there's still plenty of bull legs left, then you want to take advantage of big drops in the price to buy and add to your position. And with that in mind, Money Metals still has some good deals. I talked last week about low spot prices on random silver rounds and junk silver. And if you want gold, consider quarter-ounce sovereign gold coins. Now, I'm talking about very common coins, gold eagles, Canadian maple leaf, Swiss francs, but they're in quarter-ounce size, so they're smaller coins. And these are a great way to diversify your portfolio with gold from some of the world's most respected mints. They're basically what we call fractional gold coins, and they offer kind of a balance between affordability, because you're not paying full ounce price, and value. So they're an ideal choice for seasoned investors and people who are new to precious metals. So basically how it works is we pick the coins. We get to decide whether you're going to get gold eagles or maple leafs or whatever, but you get a better price. So check that out. If you're interested, call Money Metals, 800-800-1865. Talk to a Money Metals precious metal specialist. But, we've got some good deals if you're interested in using this dip to add to your position of gold and silver. But anyway, this isn't just about the gold and silver market right now, right? What is going on is going to impact future policy, which is going to have additional ramifications on the metals down the road. In other words, what we're seeing right now with these credit issues, that is going to kind of drive Fed policy, and we need to kind of think about what that's going to look like to help us know kind of what the future for gold and silver are going to be. Now, Booth thinks that the Fed is going to have to ease monetary policy faster despite persistent inflation worries to keep the easy money flowing and to prevent a total collapse in the borrowing markets. And of course, lower interest rate are generally bullish for gold and silver because when nominal rates, the rate that's quoted, goes down, that pushes real rates even lower. Real rates are the interest rate minus what you're having eaten up by inflation. And real rates are already pretty low right now. And if the Fed eases significantly, we could very quickly see negative real interest rates, which is definitely bullish for gold and silver. And all of this dovetails with what I've been talking about with the Federal Reserve for months. Powell and company are caught between a rock and a hard place, right? I've repeated this. I feel like I say this almost every show, but it's so important. The Fed needs to keep rates higher for longer because inflation isn't anywhere near dead. And I've seen some legitimate cases for actually raising interest rates right now. But they also need to cut rates because we have, as Greg Weldon calls it, a debt black hole. It's a great analogy that Greg's come up with. We have this massive level of debt, and it's so big, it sucks everything into it. We have this massive level of debt globally, not just in the United States, all around the world, that has been incentivized by decades of easy money, and it's sucking the entire financial system into it. This debt is having an oversized impact on the markets. Booth said, quote, "It certainly looks like the system is running out of sufficient liquidity and that the Fed is going to be forced to pull over to the sidelines." And I would argue that it already is, right? We had a rate cut at the last meeting, even though we had signs of reviving price inflation. And in another sign that we're entering into an era of even looser monetary policy, Fed Chairman Jerome Powell hinted last week that balance sheet reduction is about to come to an end. He said, quote, "Our long-stated plan is to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. We may approach that point in the coming months, and we are closely monitoring a wide range of indicators to inform this decision." Now, if you believe Booth, they're already behind the curve, right? There's already a big problem, and they're just reacting instead of, being proactive. So what does this mean? Well, in practice, the central bank is going to stop reducing its holdings of treasuries and mortgage-backed securities. It's going to maintain the size of its balance sheet at the current level. Balance sheet reduction, which is also known as quantitative tightening or QT for short, it's the opposite of quantitative easing. It pulls liquidity out of the financial system by reducing bank reserves and shifting government debt financing to the private sector. In effect, it tightens funding conditions and market debt, and it's effectively deflationary. But if we're having liquidity problems in the financial system, well, then the Fed has to kind of undo that, right? So that's why Booth said that they're going to have to stop doing it, and that's why Powell has given us this hint. Powell said, quote, "Some signs have begun to emerge that liquidity conditions are gradually tightening, thereby necessitating the end of QT." So again, if you believe Booth and she makes a compelling case, well, the Fed's already behind that curve, right? So more significantly, an end to balance sheet reduction would take some pressure off of the treasury market, off of the bond market, as the central bank would have to purchase new bonds out there on the open market as the old ones mature. In effect, it would create additional artificial demand in the treasury market, and the treasury market needs that right now. We've seen kind of a fall off. A lot of people out there don't want to take on more U.S. debt. So this would kind of ease the marketplace a little bit. Now, Powell didn't provide a timeline for ending balance sheet runoff, but I have a feeling it's going to be pretty quick. And the Fed chair also hinted that more interest rate cuts are in the cards. And he also alluded to the tightrope that the central bank is trying to walk. He said, quote, "If we move too quickly, then we may leave the inflation job unfinished and have to come back later and finish it. If we move too slowly, there may be unnecessary losses, painful losses in the employment market. So we're in the difficult situation of balancing those two things." I'm going to give y'all a hint. They ain't going to balance it. This is central planning at its best. And central planning at its best is awful because these folks, they might be smart, they might be good intentioned, they might not be, but let's just give them the benefit of the doubt. Still, they don't have enough knowledge. They can't anticipate all of the impacts of these policies. They can't understand the blowback and the malinvestments that we have. They never have been able to, and they're not going to start now. So let's kind of look at this a little deeper. Interest rate policy gets the most attention out there, but the Federal Reserve balance sheet is really an important monetary policy tool. And I would argue it might be more impactful than interest rate policy. It's definitely more of a blunt instrument, right? It's like a hammer. In effect, the balance sheet serves as a direct supply or a direct pipeline to the money supply. So when the Fed buys assets, we're primarily talking about U.S. Treasuries and mortgage-backed securities. It does so with money created out of thin air. And those assets go on the balance sheet, and the new money gets injected into the financial system and ultimately into the broader economy. This is quantitative easing, or QE. Before the 2008 financial crisis and the Great Recession, the Fed's balance sheet was just over $900 billion with a B. By the end of the pandemic era, so 20 years, it stood at just under $9 trillion with a T. In other words, the Fed pumped over $8 trillion into the economy in 14 years through quantitative easing. And we can see the impact of QE on the trajectory of the money supply. If you look at the M2 money supply, you'll see that it declined after the Fed began tightening. It went way up during the pandemic, and then it declined a little bit. And it has since resumed its relentless climb. We're actually above, the money supply is now higher than it was before the pandemic. And here's what's crazy. Ben Bernanke, he was the Fed chair that launched the first round of quantitative easing at the onset of the Great Recession. And when he did, he went before Congress and he swore that the Fed was not monetizing the debt. So what do we mean by that? Well, when the Fed buys a bond, a treasury, U.S. debt, with money created out of thin air, it is effectively turning that debt into money, right? They buy the debt and they create the money. The term is then debt monetization. It really makes sense. And at the time, Bernanke said the difference between debt monetization and the Fed's policy of quantitative easing was that the central bank was not providing a permanent source of financing. He said the treasuries would only remain on the Fed's balance sheet temporarily. And he assured Congress that once the crisis was over, the Federal Reserve would sell those bonds that it bought during the emergency. Now, shock of all shocks, that never happened. And then the Fed doubled down and expanded the balance sheet by nearly $5 trillion during the pandemic. This is, ladies and gentlemen, by definition, inflation. Now, quantitative tightening, balance sheet reduction, it unwinds quantitative easing. As treasuries and mortgage-backed securities mature, the central bank doesn't replace them. Thereby, it shrinks the size of its balance sheet over time. Since the Fed isn't replacing the bonds, the U.S. Treasury has to raise money from the public to redeem the central bank. So in other words, those bonds mature. The Treasury has to pay the Fed for those bonds. And of course, Uncle Sam is broke. So that means the Treasury Department has to sell a new bond on the open market, essentially borrowing money to pay off the old debt. Yes, we are borrowing money from new people to pay the people that we borrowed money from before. So when a private individual or a bank or an entity buys a treasury, they typically use cash, and this reduces their bank deposits. So in effect, quantitative tightening lowers the overall financial system reserves, and it shifts more debt financing to the public, and it decreases liquidity in the system, and it tends to be deflationary. So the Fed announced balance sheet reduction back in March of 2022, when it could no longer convince you that price inflation was transitory. And, even then the plan wasn't exactly ambitious. I did the math at the time. Given the amount of inflation that it created during the pandemic, if the Fed followed its blueprint, and it didn't, it would take 7.8 years for the Fed to shrink its balance sheet back to pre-pandemic levels. And this doesn't even account for the trillions added in the wake of the 2008 financial crisis. And of course, the central bank didn't stick with the plan. The Fed slowed the pace of balance sheet reduction back in May of 2024. So from its peak, the Fed has run about $2.4 trillion off the balance sheet. And that's kind of impressive, but only until you realize that it represents about half of the increase during the pandemic alone. Powell said that the Fed has no plans to reduce the balance sheet back to pre-pandemic levels. So much for Ben Bernanke's promise, right? So if expanding the money supply is inflationary, it logically follows that to truly beat down price inflation, the Fed needs to shrink that balance sheet substantially. It needs to shrink the money supply. Theoretically, it should have reduced the size of the balance sheet to at least in the neighborhood of the pre-crisis level, as Ben Bernanke promised. You may be a little bit higher to account for a bigger economy, but certainly not where we are now. Rate hikes aren't enough to wring all of the liquidity out of the economy. So if the Fed was really serious about taming inflation, it needed to significantly reduce that balance sheet, not kind of half-ass it. In other words, it needs to undo the money creation of the past decade plus. It didn't and it won't. So if inflation isn't at the 2% target right now, it's not, we're closer to 3%, why did the Fed start winding down its balance sheet reduction last year? Why are they talking about ending it altogether today? While Powell and company would never admit it, the central bank has no choice but to end balance sheet reduction due to the federal government's borrowing and spending problem, which is kind of linked to the bigger picture of global debt. When Bernanke claimed that the central bank wasn't monetizing the debt, he was either hopelessly naive or he was lying. So this leads me to a second bit of news that came out that hasn't gotten much play at all in the media because we're all focused on the government shutdown. Despite all the talk about DOGE and the cost cutting earlier this year, the federal government spent more in fiscal 2025 than it did the previous year, and it set a new spending record. Now, however, thanks to the influx of tariff revenue, the fiscal 2025 budget deficit was slightly smaller than last year, if you can use the word small, with a $1.78 trillion deficit. So last year it was $1.82 trillion. This year it's $1.78 trillion. So basically we ran the same deficit this year as we did last year. It was the fourth largest deficit in history. The only deficits that were bigger than the last 2 years occurred during the pandemic era in 2020 and 2021. To get $1 trillion deficits after that, you have to go all the way back to the Great Recession when the Obama administration ran 3 or 4 $1 trillion deficits. But that was during a financial crisis, right? We're supposedly in a great economy, and we're still seeing nearly $2 trillion deficits. Absolutely insane. Treasury Department estimates that the budget deficit to GDP ratio dropped slightly to 5.9%. Now, that sounds good, I guess. It's under 6, but typically in a good economy, it runs around 3%, so we're double that. Nevertheless, Treasury Secretary Scott Bessent was running around out there declaring, "We're on our way. We're doing better." However, these numbers are nothing to brag about. Now, I am going to offer a caveat. September looked better. We actually ran a surplus in the final month of the fiscal year. But that's actually not unusual. We ran a surplus last year as well. But this was a bit bigger of a surplus thanks to 2 things: tariff revenues, and there were some cuts in education that came through. So I'm going to give credit where credit is due. However, tariff revenues right now are about as high as they're going to get. In fact, I would guess that we're going to start seeing them go down. I mean, after all, we're supposed to be making trade deals, right? That's the whole point. So we'll see tariff revenues start to fall off, and there's going to be spending to offset these cuts. I can say this with complete confidence because there always is more spending. I'm cynical, no doubt, but until I see otherwise, I'm not going to believe anything about spending cuts. So let me run through the numbers real quick from the latest Treasury report. The U.S. government took in $5.2 trillion in fiscal 2025. That was a 6.4% gain in revenue over 2024. A huge surge in tariff revenue helped boost overall receipts. The U.S. collected $202 billion in customs duties last year. It was a 142% increase year on year, so that's pretty impressive. The government took in $30 billion in tariffs in September alone, a 295% year on year surge. So the tariffs are helping. But think about this, even with 142% increase in tariffs over the course of the year, we still ran a $1.7 trillion deficit. It's also important to note that this big increase in tax receipts came on the heels of an 11% revenue boost last year. So the government has been steadily increasing the amount of money it's taking in. The problem is clearly on the spending side of the ledger. The Trump administration blew through a record of just over $7 trillion last year. Spending was up 4.1%. So until we see the spending numbers go way down for a sustained amount of time, not just 1 month, Bessonette needs to just shut his yap. And the sad fact is that given the political incentives, people in power will always kick the debt can down the road. It's a long-term problem that's going to require painful measures to fix. Nobody wants big spending cuts. Politicians don't want to create pain. That's a quick path out of office. So they will punt the debt problem and spend more to make constituents happy. And this is all well and good, but the problem with playing kick the can down the road is you eventually run out of road. And I think the road is getting awful short. So tying all of this together, in effect, the Fed supports the government's borrowing by creating artificial demand for treasuries, quantitative easing, or even when it's not quantitative easing, even when it's holding the balance sheet steady, it is going out there and buying treasuries on the open market. That's creating demand. This drives the price higher, and it drives yields lower, which gives the U.S. government a little bit lower borrowing costs. So if you want to know why the Fed is cutting interest rates right now, this is the answer to that question, even though inflation is still very much in the picture. But here's the thing. A few rate cuts and an end to balance sheet reduction won't inject newly created money into the economy. It will reduce the number of bonds that the government has to sell on the open market, thereby easing supply, and it will lower liquidity. It will raise treasury prices. It will put downward pressure on yields. It will do all of that. But the central bank may well have to launch quantitative easing again in the near future to press its thumb even harder on the treasury market. So in effect, we're talking about a return to money printing. That's the next step. After quantitative tightening ends, we go back to QE, we start printing money again. That means even more inflation. And this, ladies and gentlemen, is why I think you probably still want to have some gold and silver over the long term, even when you see these big price contractions and corrections in this bull market. Because no matter how you slice and dice it, we're getting more inflation. I've said this over and over again. Inflation is by design. They just try to keep it low enough so that you don't get mad. But there's always inflation. Your money is always being devalued. Now it's being devalued a little bit faster. And the way things are setting up, it looks like they're going to be devaluing your money even faster as we move down the road. And I think there's a very good chance that we're heading towards stagflation, where we see low growth and higher inflation. That's just how things are setting up. I was talking to economist Daniel Lacal not too long ago. You might want to check that interview out if you haven't listened to it. He thinks that we're heading towards this long-term stagflationary system where we don't have a big crisis, but everything just kind of muddles along, and the government just keeps inflating away, and there's no real growth and no wage growth and just blah. So now's a great time to call 800-800-1865. Talk to a Money Metals precious metals specialist. Get some gold. Get some silver. Take advantage of the deals we've got. Use these folks. They're a great resource if you have questions, if you want to know how precious metals might fit into your portfolio, whether you want to do silver or gold or a mix. These folks can help you kind of work through that based on your own situation. So give them a call today. If you don't want to talk on the phone, that's cool. You can go to moneymetals.com, chat with the precious metals specialist right online. Or if you know what you want, just go look up the product and you can buy it online. We'll ship it right to you, or we can store it in our state-of-the-art bullion vaulting facility. And that opens up the opportunity for you to take out loans against your gold and silver. So a lot of options out there. So give us a call today, but don't wait, because things aren't going to get any better. I've been saying this a lot. This is not a situation that you can vote away. It's not a matter of, we've got the wrong people in charge. No, the whole system, the whole premise of the way the system operates is broken. It's all central planning muckety muck, and this is what you get. So That is a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up, get on our email list. Of course, if you haven't done it already, you can subscribe to the Midweek Memo podcast on your favorite platform. And when you do, you'll also be able to tune into our Market Wrap podcast, which runs every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. This week, I'm going to have the privilege of talking with Axel Merck, and he's always a good interview, so check that out. Again, thank you so much for listening to the show. I hope you have a fantastic rest of your week, and I will be back here behind this microphone again next Wednesday.